If you own just 1,000 XRP, listen closely. The next stretch into 2026 can redefine what that small bag means for your future if you understand how cycles, liquidity, and patience actually work. This is not financial advice. It is education, context, and a map for thinking. What I'm going to share is the playbook institutions quietly use while headlines distract everyone else. Start with the macro, because the macro sets the tide. When interest rates trend lower, the cost of capital falls, balance sheets loosen, and risk appetite returns. That shift does not hit your chart the next morning. It travels through banks, through corporate treasuries, through bond desks, and only then into stocks and crypto. That journey takes 3 months to start, 6 months to build, and roughly a year to fully express. We are in the early chapters of that journey now, and that is why you cannot afford to judge the future by today's candles alone. Every big cycle rhymes. After the dot-com bust, rate cuts and liquidity eventually reignited risk. After the global financial crisis, unprecedented easing set the stage for a powerful recovery. In 2020, when panic peaked, liquidity rescued markets and launched a historic run. The features change. The pattern repeats. Capital seeks growth, the dollar weakens on a relative basis, and investors hunt for exposure that can move faster than traditional assets. That is where crypto lives. And within crypto, the assets with clear jobs tend to outlast the noise. Utility is where XRP stands apart. XRP is built for one job: moving value quickly, cheaply, and at scale. It is not trying to be everything for everyone. It is trying to be the best at one thing that actually matters when real money moves: efficient settlement. Seconds instead of hours. Fractions of a cent instead of multiple dollars. Deterministic finality instead of guesswork. When liquidity increases, efficiency gets rewarded because friction is expensive. Contrast the narratives. Bitcoin is digital reserve, the macro hedge. Ethereum is programmable capital, tokenization, and staking. Both will matter, but neither is optimized for high throughput, low-cost global payments. That lane belongs to systems designed for throughput from day one, and that is why institutions evaluate XRP differently than retail often does. Retail asks, will it moon? Institutions ask, will it clear, will it scale, and can we trust the rails? If you hold 1,000 XRP, you are holding a claim on that rail. The size may feel small, yet the leverage is in the cycle, not in leverage itself. Imagine 3 paths. Conservative, a return to old highs during a broad risk-on period. Moderate, old highs plus an efficiency premium as adoption deepens. Aggressive, widespread integration into corridors, platforms, and treasuries that need fast finality. The numbers change with each path, but the logic is the same. Utility attracts flow, flow begets price discovery, and discovery invites more flow. Volatility will try to trick you. Volatility is not the enemy, it is the toll. It shakes impatient holders and pays the patient. Red candles are the discount window for strong hands. Green candles are the exit liquidity for weak ones. You already know how most people behave. They sell near supports because fear shouts louder than reason. They buy near resistance because euphoria whispers promises. Institutions invert that script. Buy red, distribute green, and let time compound positioning. Time is your quiet advantage. Liquidity transmission is slow at first, and then suddenly obvious. The big move is rarely announced. It is built quietly by accumulation during boredom and fear. That is why the next 12 to 18 months matter more than any single week. This period is the foundation pour. By the time headlines admit what is happening, the structure is already framed. Now add something most viewers miss: the data layer that supercharges settlement. I am talking about Flare. Think of XRP as the highway that moves value and Flare as the instrumentation that feeds real-time, verifiable information into the system. Oracles and state proofs sound technical. What they really mean is trustworthy automation across chains and off-chain data. When you combine fast settlement with credible data, you unlock payments plus programmable logic without jamming friction back into the process. That combination is a blueprint institutions actually understand. I will give you a simple framework to keep you centered. 4 lenses: macro, flow, utility, and psychology. Macro tells you the direction of the tide. Flow tells you where the water is pooling. Utility tells you which ships can actually carry cargo. Psychology tells you who will climb aboard and who will jump overboard at the worst possible time. Revisit those 4 lenses every week and you will hear the signal beneath the noise. Let us get practical. Map zones, not ticks. Define demand areas where buyers revealed themselves before. Define supply shelves where rallies paused. Accept that markets breathe, test, reject, reclaim, and expand. If price retests a known demand zone and buyers defend it, that is structure, not disaster. If price reclaims a shelved level and holds, that is information, not a miracle. Structure plus time equals trend. What could 1,000 XRP be worth across those paths? I'm not going to hand you a guarantee. I'm going to hand you lanes. Lane 1, conservative. The asset revisits prior highs in a broad, orderly advance. Lane 2, moderate. Structural adoption plus rotation from larger names drives a measured expansion beyond those highs. Lane 3, aggressive. Institutional integration into payment corridors and treasury rails accelerates demand faster than supply can respond. In Lane 1, 1,000 units are meaningful. In Lane 2, they become strategic. In Lane 3, they can become life-changing. The difference is not a prophecy. It is the interaction of liquidity, adoption, and time. Notice what is missing in that framework. A need to predict the exact week. Precision of timing is entertainment. Precision of preparation is edge. You prepare by deciding where you will add if the market gifts you discounts, where you will trim if the market gives you exuberance, and how you will behave when nothing seems to happen for weeks. Boredom is a position too. Most traders cannot tolerate it. Investors who can usually inherit the move. Let us return to macro for one more layer that most ignore, the bond market. When yields fall with the path of policy, the opportunity cost of holding long-duration growth declines. That frees capital to pursue convex outcomes. Crypto is convex by design. Small changes in flow, narrative, or access can drive disproportionate price moves. Pair that convexity with rails that settle in seconds, and you have a logical destination for capital that needs agility. Global structure is shifting as well. More trade is settling outside single currency channels. More institutions are piloting instant clearing. More regulators are writing frameworks instead of pure enforcement. That trifecta reduces friction, and whenever friction falls, volume grows. Again, efficiency wins. Again, XRP's design shines. Fast, cheap, repeatable. You should also understand the theater of headlines. A scary narrative will arrive on schedule. It always does. Some data point will miss, some lawsuit rumor will circulate, some exchange issue will trend, and a wave of certainty will sweep across social feeds that this time is different. Meanwhile, the tape will often mark a higher low. The quiet bid will reappear, and the next leg will build when the audience is looking away. If you have mapped your zones, sized with respect and accepted variance, that cycle becomes survivable and even profitable. Let me address the emotional traps directly. Fear of missing out tells you to abandon plans when price runs. Fear of regret tells you to abandon positions when price dips. Professional money replaces both fears with rules. Rules about entries and exits. Rules about how much to allocate at each zone. Rules about invalidation that are honored without drama. You can borrow that discipline today by writing your rules before you need them, and then executing them when your feelings argue otherwise. Where does flair return to the story? Right at the intersection of utility and automation. As institutions connect internal systems to external rails, they need data guarantees. They need proofs that an event on one chain really happened before releasing value on another. They need price feeds that cannot be gamed cheaply. Flair's architecture aims at that exact set of demands. It is not a replacement for XRP's settlement strengths. It is a complement that can widen the practical surface area for builders and enterprises. I will unpack this fully in the next episode so you can be early to the synergies others will notice late. Here is a mental model that keeps you patient. Think in seasons. Accumulation season when the crowd is bored or angry. Expansion season when structure resolves and momentum confirms. Distribution season when narrative turns euphoric and crowded. Protection season when you convert a portion of paper gains to durable outcomes in your real life. You do not have to time them perfectly. You only have to recognize the season you are in and behave accordingly. As for risk, honor it. Use position sizing that lets you survive variance. Use a personal invalidation line that says, if structure breaks here and does not recover, I will step aside and reassess. That is not weakness. That is professionalism. Survival is the first alpha. Longevity is the second. Compounding is the third. You need all three to be around for the outcome you seek in 2026. Let me tie everything into a single, simple sentence you can repeat when the feed gets loud. Liquidity plus utility plus time equals outcomes. Liquidity comes from policy and credit. Utility comes from design and adoption. Time comes from discipline. Miss any one of the three and you are gambling. Align all three and you are investing. So, if you own just 1,000 XRP, what should you actually do in practice? Number 1, know your zones in advance. Number 2, decide your adds and trims today, not in the heat of the moment. Number 3, commit to a review cadence, weekly is enough, to update levels without overreacting. Number 4, keep a journal so you can see your own patterns and interrupt the ones that cost you money. Number 5, remember why this asset exists and who evaluates it for its real job. Finally, remember the nature of cycles. They are designed to test conviction. They will test yours. There will be days you are certain nothing is happening and days you are certain everything is happening at once. Neither feeling is truth. The truth is in structure, in flow, and in the calendar that moves regardless of your attention span. When 2026 arrives, the market will not ask whether you meant to hold. It will simply price whatever you actually held. If you found this useful, make a quiet commitment to patience and preparation. Map your plan. Protect your downside. Give your upside time to arrive. I will break down the flare connection in the next episode, so you are early to the synergy most people will only notice in hindsight. Until then, stay steady, stay informed, and treat volatility like the toll it has always been, the price paid by the impatient to the patient. Before we close, let us pressure test the 3 lanes with concrete examples so the differences are tangible. Picture lane 1, the conservative path. Policy eases, indexes grind higher, and crypto follows without mania. In that environment, XRP revisits prior highs slowly, pausing often. The edge is steady accumulation at demand, patient holding during plateaus, and a willingness to accept boredom while structure quietly improves beneath the headlines. Lane 2, the moderate path, has a different signature. Weekly candles close above former ceilings, pullbacks respect reclaimed levels, and rotations drift from headline names toward payment rails and data infrastructure. Builders demonstrate working systems, not slides. In this path, you pre-write profit targets, scale out into strength, and plan redeployments for orderly pullbacks. Your decisions are scheduled by rules, not scheduled by emotion or social chatter. Lane 3, the aggressive path, is rarely comfortable. Liquidity chases speed, adoption headlines cluster, and the tape outruns your notebook. In that chaos, rules matter most. Predefine your ladder, your invalidation, and a real-life conversion target. Rent, debt, tuition, or seed capital. So a slice of digital gains becomes tangible progress. The common regret from past cycles is not holding too little, but converting too late after euphoria fades. Access and custody deserve the same planning energy. Make sure you can acquire, hold, and move XRP when needed. Test small transfers before moving size. Keep simple records. Separate long-term holdings from any trading inventory so short-term noise does not contaminate long-term decisions. Diversify custody only if you can manage it properly. Security is part of performance. Lost keys erase returns. Habits and checklists prevent avoidable permanent mistakes. Here is a weekly ritual that tracks the tide without drowning in data. Write 3 lines every Friday, one about macro, one about flow, and one about structure. For macro, note rates, dollar, and credit direction. For flow, note where rotation is clustering. For structure, note levels reclaimed or defended. 12 weeks of notes create conviction. Conviction reduces panic. Reduced panic improves execution. Improved execution compounds quietly, then shows loudly. Treat this like a craft, not a stunt. Crafts reward deliberate practice. Stunts rely on luck. Crafts survive winters and harvest summers. Stunts burn bright and disappear. You are not aiming for internet applause. You are aiming for durable outcomes. Show up, review your plan, and honor your rules. Endurance wins the long game, and endurance is built by simple behaviors repeated consistently. Like, comment, and subscribe for more content.